Please, we have Vijay Balacha, Chief Investment Officer from Century Financial. Vijay, we start with the oil. What is supporting the oil in today's trading session, in your opinion?
Well, multiple factors. I would say there are six factors contributing to oil prices right now. First being, of course, the US inventories, but more importantly, the US actual supply of oil. The US actual buildup of oil is increasing quite significantly, which has been quite bearish for oil overall. Second, we do have, of course, the geopolitical tensions, why actually oil is actually moving upwards. Third, we do have the US Fed rates, where the US is now not very sure if they want to reduce the rates at a hurry. They want to go a little slower because they do expect that inflation can be much more sticky, or in fact, in the worst case, we can see a rebound in the inflation prices. Well, the fourth factor, which is also very important, is China. China is not doing so well. We are seeing every day bad news coming out from the country. We are seeing, even though there's economic stimulus going on right now, but still there is a lot of bad data coming in from China. That's actually bad news. Well, number five, of course, we always have the OPEC, which is not speaking anything right now, but the OPEC Plus can come out anytime with more oil cuts, which could be bullish for oil. And number six, of course, India's resurgence. Is India the new China? Is of course the question. Well, the answer, of course, nobody knows. But yes, India definitely has the capability of becoming as at a faster growth rate as China was between the 1990s all the way till 2020.
Those six factors which you have pointed out to Vijay, we have supporting factors and non-supporting factors for the oil prices. So does this mean, are we going to have to continue trading at these in this range for a longer period of time?
Yes, absolutely. The market does look sideways. Only a breakout on Brent above 85 levels will be an actual breakout. We are seeing an upward moving triangle right now, but till it doesn't break out about 85 levels, it still remains pretty much a range bound trading instrument right now. Of course, there could be a geopolitical tension which could easily make a breakout on a single day. We have seen oil to be volatile in the past, not so much in the last 3 years, but in general, a big event always moves oil in big prices. A geopolitical event is the most likely to actually create a breakout. So that is what we actually think that can happen to actually break out the range.
As per the IEA, they believe that India will lead the growth in the oil demand globally. The main factor they're talking about is the increase in the number of the population. However, Vijay, we see that they are focusing more on the EVs and manufacturing EVs in India. The question is, which of those two factors will be more important for the global oil demand and the Indians specifically, when knowing that those two factors are contradicting?
Well, actually, they're not so contradicting. India's growing population is actually at an alarming rate. So it's not that the EV market will not grow. The EV market will also continue to grow, but so will the industries which require oil. So overall, I think India's demand is definitely a bullish sector for oil. At the same time, the last time we actually did believe that India is going to grow at a faster rate than China was probably at 2008, and that was a scary year. So we don't want to repeat of the past, but at the same time, this time it does look like India is on a breakout. So if it does happen, it will definitely be a bullish signal for oil.
As we all know, Vijay, that also the Indians are among those who buy the gold the most. The question here is, with the increase in this growth, increase in the population, will also gold be supported by the demand from India?
Yes, definitely. I mean, it has been passed on from generation to generation in Indians that gold has to be bought. So, yes, gold demands is definitely going up. At the same time, I don't really think that makes a much bigger impact on gold prices to say. It does make on physical gold, but as such, not on the prices. We can, I mean, the buying could probably increase gold prices by $20 a year, but not really significantly. The significant move on gold prices will come on when the Fed will cut rates and how by how many basis points.
Vijay Valecha, Chief Investment Officer at Century Financials, thank you for being with us.
Thank you so much.